I'm Charlotte McLeod with investingnews.com, and here today with me is Justin Huhn, founder and publisher of Uranium Insider. Great to have you as always. Thanks for joining me today.
It's my pleasure. Good to see you again, Charlotte.
Yeah, really great to be talking with you, especially because we're coming off a pretty exciting week for uranium. So prices, I believe we had them at a 12-year high. And on top of that, I believe you said in one of your recent videos, we have the spot price up about $10 over the course of 4 weeks or so. So we're going to talk about some of the drivers behind that move. But where I wanted to begin is if you could talk about just how, I guess, contextualize that in a market where we know usually moves pretty slowly.
Sure. We've been in a quote unquote bull market for uranium and for a number of years. I wouldn't necessarily call the beginning of the bull market the first move up after bottoming, but kind of breaking out above previous resistance. So let's say we're in a bull market over the last 3 years for the commodity. There's been some price spikes. There's been some mild drawdowns. There's been a decent amount of consolidation over the past year and a half, especially for the equities, but also for uranium as we spiked to $63.50 a pound last April of 2022. That move, of course, was entirely driven by financial interests, SPUT, Physical Uranium Trust specifically. But really what we're looking at here is confluence of a number of events, both acute and I don't want to say chronic, but kind of longer term macro developments. So the overall embracing of nuclear is sort of just this underlying foundation to the thesis that makes the demand story relatively predictable. It's basically pretty static and slightly growing. In fact, the growth numbers are continuing to move higher, where a few years ago, the growth in nuclear was looking like it would be 1 or 2% per year, compound annual growth rate going out, 2035, 2040. Now that CAGR is closer to 4 or 5%, possibly even up to 6%, depending on who's doing the analysis. So we have this underpinning of this beautiful demand story and this re-embracing of nuclear and carbon neutrality goals and energy security during a time where energy is being weaponized in certain parts of the world. And so that's sort of this underlying demand thesis that's relatively easy to model out. The supply side, however, is a big fat question mark, where you've had a situation where there's been abundant and relatively cheap supply of uranium for a very long time. Even in the previous bull market, we had kind of supply scares on the backdrop of a pretty robust Chinese build-out. And we had a mine flood, of course, at Cigar Lake in 2006. And even prior to that, the price had started to recover, but we never were actually in a supply deficit when it came to relative to total demand. And we had a number of secondary supply factors back then that don't exist now. So the supply side, we're ever so slowly, and then over the last few months, I would say the last 6 months, very, very quickly. So it's kind of like slowly and then all at once, right? So very slowly that ship started to turn, the price started to recover, the SWU price started to recover, enrichment, conversion price started to recover, all elements of the fuel cycle have been moving up. We had a couple of unique events, which was, of course, COVID, and then more recently, the invasion of Ukraine that definitely stirred things up within the fuel cycle. But finally, we're at this moment in time where the supply side has gotten so squeezed, for lack of a better word, that very, very low volume demand in the spot market is moving the price significantly. And this is a big wake-up call to utilities, because most of these utility fuel buyers have been around for a while. A lot of them, if not most of them, experienced the previous bull market. They understood what happened when the financial players came after uranium. They understand the markets decently well, but what hasn't happened ever, regardless of how long they've been in this industry, what hasn't happened ever in their careers is a situation where they had a hard time actually finding the uranium that they needed at any price. And we're actually approaching that situation here. And it's a bit alarming, but from an investment standpoint, it's quite exciting. I think that we're in store for some pretty significant moves in the uranium price. And what we just experienced over the past 4 to 6 weeks is evidence of that. Never have we really seen a big move in August, at least over the past decade, with an exception of 2021, which was SPUT's ATM went live, right? August of 2021 is when we saw a price move in the uranium that month. But usually the summer is slow. We usually see the spot price flat, if not slightly pulling back. This year was different. Even with relatively low activity in the spot market, the price stayed firm and in fact rose. And then just over the past few weeks, we've seen an almost $10 move in the spot price. And it's there's a lot of reasons for that. I hope I touched on a few of those, but it's a very, very tight supply market right now. And really the question everybody should be asking is, where is that relief going to come from? And I don't think anybody really has a great answer for that, myself included.
Okay, yeah, I think that does get us started on understanding where this pretty big move has come from in the last several weeks. So you described, and I'm hoping you can go into this in a little bit more detail in some of your recent commentary. You're talking about an inflection point here. And let me see if I get this correct. I believe you're referring to, this increase in the price. We're seeing uranium move more by these supply and demand fundamentals, whereas previously increases in the price that we saw were driven by things like the Sprott Physical Uranium Trust SPUT. So I wondered if you could go into that a little bit more.
Sure. Yeah, the Sprott Physical Uranium Trust is really kind of a unique vehicle and a unique moment in time with its inception over the past couple of years. So, and they had two periods where we had significant risk on capital environments and money was flowing into this vehicle, and they were raising a lot of money via their at the market financing vehicle, the ATM, and buying a lot of uranium. So they took over UPC, Uranium Participation Corporation, in, I think it was April of 2021, March or April of 2021. ATM went live in August, and they immediately saw incredible capital flows where they were raising 20, 30, 40, 50. In fact, they raised up to $100 million in a single day on a couple of occasions. It's a lot of money. They purchased a lot of uranium. They purchased over 40 million pounds of uranium in the past, over the past 2 years. And that was primarily done during these two periods of time. The first was late August 2021 until about mid-November, and then again March, April 2022. Since then, they've been trading at almost an exclusive discount to their net asset value, which doesn't allow them to raise cash and therefore buy uranium. They've had to draw down their cash balance, and only until recently started raising cash again. But the most important element to understand with Sprott's effect on the market has to do with the above ground mobile inventory that they essentially consumed. That uranium has, unofficially gone to uranium heaven, as they just basically store that uranium. However, they have recently brought up that they're considering filing for a redemption mechanism with the Ontario Securities Commission to be allowed for industry players with certain restrictions that we don't know about yet to redeem for a physical uranium. But that, I think, is a brilliant move. I really hope that it gets approved when they do actually put forth that application. But because that'll keep them very close to discount to NAV, and it'll satisfy some utility pressure based on this trust is hanging on to these pounds. But I regress. Going back, we had an incredible above ground mobile inventory following the previous decade. So the bear market, the Kazakhs continued to produce a lot of uranium. That flooded the market. They were able to make money primarily because of an arbitrage with the currency. They had a fast depreciating currency with the Kazakh tenge, which their production costs were in, but they were selling in US dollars. And that essentially allowed them to produce and actually make a profit at prices that were basically lower than even they were able to produce at, right? So their cash costs are very low, but the all-in costs, especially the fully allocated costs now that they're public with the dividend, they still need probably in the $40 a pound range as the lowest cost producer. So the price overshot to the downside significantly. But this environment was such that the utilities basically, they never had a concern about supply. It was always there when they needed it. It was so cheap that they could buy from the Kazakhs, they could buy from the Uzbeks, they could buy from the Russians at way lower prices than were necessary for the Western producers, so that would be Cameco and Orano primarily, that they had to actually shutter production, which they did. They shuttered McArthur River, the biggest uranium mine in the world, in 2018. And it's taken a very long time to work through that inventory. Well, this inflection point we're at now essentially is we are through that inventory. The only inventory that exists now in the world is strategic. So this is held by nuclear utilities, and their inventories, historically speaking, are relatively low, and by nation states. So by far, the biggest holder of inventory is China. They probably have somewhere to the tune of 400 plus million pounds of inventory, and it sounds like a lot, but when you look at their build out, it's really not that much. They have 6 construction starts this year already, and another 6 to 8 in the next 6 months. It's incredible how quickly they're building plants. They're going to need that uranium. So that's all to say that SPUT has done the heavy lifting already. And one more piece of color I'd like to add to that is it wasn't just above ground mobile inventory that they worked through, because there were 2 periods of time when they were buying where we saw the spot price jump up pretty significantly above the term price, the long-term price of uranium. So that's considered a backwardated market, right? The front end of the curve is higher price than the long end of the curve. What that allowed traders to do was sell to SPUT their uranium that they held on their books, that those pounds had an eventual home. A trader had a midterm contract with the utility, and 2-3 years out on the curve, those pounds would be delivered to that utility. Yet they're holding them on their books now, and the price just went up from 35 to 50 bucks. And here I am holding these pounds, and I can sell those to SPUT for 50 bucks, and I can go back and cover in the midterm for 40 bucks. And they did that. And so what I'm trying to say is that some, probably close to 40-50% of the buying that SPUT has done has come from what might be referred to as a carry trade unwind. These are pounds held by traders that they basically are pulling forward pounds on the curve when the price gets backwardated and there's a lot of buying coming from a financial entity. So that's all to say that SPUT didn't only clean out kind of the last remaining above ground mobile inventory that had been sort of sitting around from the previous decade. They also shook out pounds that had committed homes. They pulled forward that demand. Now the midterm of the curve is extremely undersupplied. And I don't want to keep rambling on, but this is one more really important point when you're thinking about the midterm, because I started calling the midterm basically the supply black hole. We're talking about 2024 to 2026. Most of these primary producers are essentially sold out of uranium. You're talking about Cameco, Kazatomprom, Orano. They've been not only signing a lot more in term contracts recently over the past 18 months, but also their legacy contracts with utilities have been fully flexed up. So all of the utilities that have signed contracts in the past with these main producers have opted to receive more uranium in that allowance in the contract than the original amount. So this was one of those things that was negotiated by utilities, and this is classic bear market, low commodity price sort of action. When it's a buyer's market, the buyer can dictate the terms. When it's a seller's market, the seller dictates the terms. So previous decade was a buyer's market. And when you're signing a contract in 2019 with Cameco and you've got $45 fixed as, let's say, half of the contract, the other half of the contract is market referenced. Well, if you're a utility now and you've got uncovered needs out of the future and you have to come back to the table anyways at some point, if you can push that off and hope that the market comes back down to where you want it to, which it's not, but let's just play this out. You're going to exercise that option to bring more uranium to the table in that contract at a fixed price that's way cheaper than what you can get it for right now. So all of the utilities have done that. All of the main producers have seen all of their legacy contracts flexed up to the extent that they could. And that has also tightened that midterm, because now we have producers that are having to sell down inventories or have production from right now and next year go to these flexed contracts instead of selling into the midterm. It's just a very, very tight market until and unless we have new production, restarted brownfield or greenfield uranium mine production coming online. And we're still a ways away from that coming in any significant volumes.
Okay, we're going to keep talking about supply, but before I ask you a little bit more about that, I want to ask you about that SPUT Physical Uranium Trust limited redemption feature, just because you started to talk about it. I know you cut yourself off, but I think it's interesting to look at because it's been introduced, but they've really said, hey, we don't really want to talk about this too much right now. And I'm curious if there's any other color that you can add to that, because I think people are pretty curious about it.
Sure. I can sort of, speak to what was stated in the press release, but also kind of pontificate on what we're reading in the tea leaves and hearing around the industry that is unsubstantiated. But essentially what they stated in the press release was that redemptions would be allowed to certain entities on no less than an annual basis. So my understanding based on that statement is if you're a utility and you own trust units in the SPUT Physical Uranium Trust and you want to redeem for physical, you can only do that ever so often. So maybe once a year you can actually redeem for physical. There's also going to be size limitations, probably on both ends. They're not going to deliver to anybody who owns a couple hundred units of the trust, and they're going to deliver a few pounds in an Amazon package. It's not going to happen like that. It's only, from what I understand, it's only meant to be delivered to industry players, end users. Part of the reason for that, I'm sure that the end users are or will be putting pressure on the industry because of how tight the supply situation is, that we've got this financial entity just sitting on 60 million pounds. That's uranium we could really use. Well, if we can free some of that up, that will satisfy that a little bit, but it won't necessarily be pounds that are going to be sold into the market. So there's always been a concern that eventually we get to such a high price, SPROT's just going to start dumping the pounds in the market. Of course, anytime you ask John Chapali, the CEO of SPROT, he'll be like, yeah, that's ridiculous. We have no intention of doing that. That would require a shareholder vote, and our shareholders would never allow it. But this mechanism would also have kind of the primary, or I guess secondary effect of keeping the trust trading much closer to NAV. The reasoning being, if you buy trust units at a discount, you redeem for physical at NAV. So if the trust is trading at 5, 6, 7% discount to NAV, you're an industry player and you've met all of the other requirements based on this mechanism that has yet to be approved. You can actually be redeemed to physical at NAV, and therefore the purchasing at a discount, you're literally buying uranium at a discount. That's very attractive to industry players. So what that means is we're not going to see, assuming this gets approved, we're not going to see a 15% discount to NAV. That is going to be bought, it's going to be bought up far prior to that steepness of a discount by utilities, by industry players that can buy physical at a discount and redeem. So there's a lot we don't know about this. Even in the press release, they were like, don't ask me anything. This is what we're giving you so far. Just leave it. We'll tell you more when we know more. So that's my understanding. Limitations on size, both on minimums and maximums, limitations on frequency, limitations on who can actually do this. So it's not going to be a uranium free-for-all. And it's also going to have the secondary effect of the trust is going to trade very close to NAV from here on out, which means they're going to be able to raise money more often.
Okay. So very typically opaque, at least for this point in time. But that is kind of exactly what I was hoping you would get at, because I think maybe when I first read that, I was like, oh my goodness, is this all going to come back? But no, it sounds like, at least from what we know so far, that's not something that's going to happen.
Correct.
So
we very much like this development and hope that it goes through.
Okay, very good to know. And so if we go back to supply, so you've painted us this picture of how SPUT came in, they cleaned up the market, and more than cleaned up, they brought forward that supply, as you were talking about. So meanwhile, we also have some recent developments. We have Cameco and its production cut for this year, I believe, by 2.7 million pounds or so. We have the coup in Niger, which I believe the companies there at first said, okay, it's fine, but there have been some developments since then. So we've got these disruptions in supply that I thought we could also talk about, and if there are any others that you think of that you would mention.
Sure. Yeah. The supply story is really where I think investors should focus on most of their efforts if they're doing due diligence on the sector. And it's really where we've been focusing a lot of our efforts as well. Because the demand story is just so robust. And yeah, there's nuance. There's reactor restarts. There's life extensions. There's new builds announced. Occasionally we have an early retirement, though it's been a little while since we had one of those. I think the last one was in Belgium, but even Belgium is life extending their remaining reactors. So the demand side is awesome, but it's not necessarily worthy of all of your time and research into the sector if you are doing so. The supply side is really where all the nuance is. And you have a number of factors right now. So yes, Cameco did announce they were likely to not hit their production targets. They're now shooting for, I think it was 15 million from MacArthur, no, 15 million from Cigar. The numbers off the top of my head, I apologize, I don't have them. But yeah, it was 2.7 million less than they were expecting. And so that shook up the market a little bit. It's not a huge amount of uranium, but for a company that's having all their contracts flexed up and doesn't have a lot of capacity going out a few years, and a company that is kind of at the forefront of the industry and kind of the industry darling, if they're having problems with supply chains, with hitting production numbers, with labor, how is it going to be for the brownfield or let alone greenfield developers, people that are building a brand new mine, especially in a jurisdiction that's less, not necessarily kind of like a first world jurisdiction and less robust in terms of labor availability and jurisdictional safety like Saskatchewan. So that's one element. So questions about Cameco hitting their marks. Another element, like you mentioned, in Niger, there was a coup about 6 weeks ago, if I recall correctly, about 6 weeks ago. And most importantly, in Niger, Orano has been a producer there for about 50 years. They continue to operate at the mine site, but they have recently announced that they are going to temporarily halt the processing of ore because the border essentially is closed to them in or out. And so they wouldn't be able to ship that material if they continue to operate their processing. So that's a significant thing because the country has seen something like 5 or 6 coups, I think, or it's possibly even more over the past 50 years, and it has never interrupted their mining operations ever. And so this feels a little bit different, but really kind of the other big story in Niger is Global Atomic is building one of the more near-term supply stories, one of the more near-term supplying mines, the Dasa mine, that the industry is essentially banking on, 3, 4, 5 million pounds of uranium coming out of the Dasa mine in just a couple of years. And this has definitely delayed that. It's delayed the financing for the company. This will still be a mine, but it's just yet another piece of evidence that the supply side is in question, and it's fragile. It's fragile. So it remains to be seen how the situation is going to play out in Niger. Like I said, Dasa is the highest grade deposit in the entire continent. It will be a mine. Whether or not Global Atomic builds it, they get bought out, somebody else takes over, I don't really know. Can't really speculate on that. But they do have a couple of contracts in a couple of offtake agreements, right? That we're expecting some uranium in 2025, 2026. Well, that's pretty much off the table at this point. So, it's not a huge producer of uranium, Niger, but it's not nothing. It's 5 or 6% of annual production. The last big thing I should mention would be just Kazakhstan. Kazakhstan is the primary producer in the world, period, the end. Nothing comes close. Nobody comes close. Kazatomprom has a couple of challenges. One, their most recent large mine joint venture was pushed through back in December with Rosatom, with the Russians. That, of course, was something that shook out a lot of Western investors in the stock. And it's in a time where Western uranium demand in terms of Western nuclear utilities are starting to kind of go, I'm not really sure this jurisdiction that we've relied on hand over fist over the past decade is starting to look a little bit more tricky. Shipping's a little bit problematic through the port of St. Petersburg in Russia, and the Western route to go through the Caspian, the Black Sea, and it's a mess. It's a mess, to put it lightly, and it's an expensive mess. It's, the cost of shipping material west versus through the port of St. Petersburg is pushing 20x. That's not nothing. So more and more of the pounds coming from Kazakhstan are highly likely to just remain in the east because they're increasing their ties with Russia. They're increasing their ties with China. The Chinese are building a huge uranium warehouse right on the border. And most of the nuclear and therefore uranium demand is in the western part of the world. And so it's a huge shakeup. And when you're looking at this supply black hole going out a few years, 3 to 4 years from now, we don't have a lot of relief. We've got some small stuff coming online, some ISR projects in the US, ISR stuff in Australia. The Uzbeks are trying to ramp a little bit. The Kazakhs are going to ramp a little bit, but we're talking about, 5, 6, 7, 8 million pounds a year, maybe more than what we're producing now globally 3 years from now. Okay. It's not a lot, and it's way insufficient. And so we don't even approach anything resembling a balanced market until we've got DASA producing, Honeymoon producing, all of the US ISR producing, Phoenix, Denison Mines Project in the Athabasca producing, Arrow producing. I mean, best case scenario, we're talking 5 years from now. And even then, it's like a moment in time snapshot. Supply maybe reaches that structural demand, but structural demand is just the burn-up rate in the reactors for that particular calendar year. We're not talking about inventory builds. We're not talking about SMRs. We're not talking about financial and secondary demand or producer demand for that matter. So it's a structurally undersupplied market, and nobody knows where that relief is going to come from.
Okay, so if you are right now a utility, how are they feeling at this moment? What is your sense? Are they feeling the heat? Because we hear a lot that they're price agnostic. They don't mind if the price goes up. They just need to buy. But if we're getting into this black hole of supply scenario, that sounds like maybe something that you would worry about, even if you don't mind paying a high price.
Sure. Well, I think that there's a handful of utilities whose fuel buyers have been first movers, and they look pretty damn smart in hindsight. Some of which I remain, in contact with, who are covering their needs out to the end of the decade, 2 to 3 years ago, and they, of course, were in contact with the investing side. And the investing side, because they have their own money on the line, they tend to do even better work than the industry itself. The industry price reporters and analysts, they don't really have a responsibility to see the future. They don't have a crystal ball, and it's not their job to tell a utility this is what the price is going to be in 2026. Their job is really to report on what's happening in the industry and report on pricing. This deal was done at this price, and this deal was done at that price. Not necessarily to say this is about to happen. Whereas the investing side inherently is always trying to discount the future, which is why there are so many, not so many, but amongst the investing side, the dozen institutions that have even looked at uranium, a few of them have done incredible deep work, Sachem Cove and Segra and Tribeca and Old West and L2 primarily. They've all done incredible work on the sector, and they were making very large contrarian bets when the sector was out of favor, but they could see what was going to happen, and it has happened. I mean, Mike Alkin and Tim Chilleri from Sachem and the guys from Segra, I mean, they were right. They were right, and then we were right. So here we are, and we're still, I think, in somewhat early stages because the contracting cycle is literally just starting. But to circle back to your question, I think that the utilities, to your point, you often hear a question like, why didn't they load up more when uranium was cheaper? And I think that the easy answer to that is that a fuel buyer, has to answer to a budgetary committee. So there's only a given budget, and that budget is based around market pricing. So when you're looking at your annual purchasing budgetary allowance and you're looking at the current market prices, you say, okay, we can buy this year, and that's what you do given those constraints. B, there's no incentive for a nuclear utility fuel buyer to make a bold move of predicting the future price and buying more than what they're necessarily allowed to or should be buying at that moment. So if you're covered out to 2025, let's actually even push that even further, because this is another interesting point with this sector. It's so different from any other commodity that demand in the 2030s matters right now. We're starting to see evidence of that. But let's say you're a nuclear utility, and right now you're covered until 2026. You've got some uranium, some UF6, some EUP, and you've got the next load, the next 2 core loads of fabricated fuel in your inventory. You're covered until that point. Well, you're going to start looking for that 2027 to 2032 period, maybe 3 years before it's needed. And you don't necessarily have to be looking for that prior to that, because you've never had to before. Ever in your career have you had to try to jump the market and get material because material was in short supply? That has never happened. Well, that's what's happening right now. So you don't have an incentive to hopefully be right and buy more than is necessary. So one more example on this front. If you can buy material from the Russians in 2018 for $30 a pound, and Cameco's telling the market we need 45. Not a single utility came to them and said, hey, we're going to take one for the team and pay $15 a pound more than the rest of the industry just so you can keep your mine operating. Like, nobody did that because you couldn't. You would never be allowed to do that from your upper management as a nuclear fuel buyer. So the smart fuel buyers bought more than they needed when the price was low, but there weren't a lot of them. And most of them cover their needs when their needs need to be covered. So if you look out and see that 25% of the industry is uncovered in 2026, and even more going out in 2027, and more every year after that, incrementally, you know that buying pressure is happening now. And we're starting to see that. We're starting to see RFPs stack up in the market, with delivery starting as soon as next year. So some utilities are coming out for material next year, which is crazy, but it is what it is. There are going to be early movers, but there are going to be late movers. And the late movers are just going to have to pay what the market requires them to pay, because they can't be without fuel, period. So yes, they will pay what is necessary. Of course, depending on the electricity market, if we see $150, $200 pound uranium and you're operating, you have to compete with natural gas or solar in the United States, that becomes a problem. So we'll cross that bridge when we get there. But 65, 70, 75, 80, the contracts are being signed right now. It's a seller's market. So they're market referenced, mostly, if not entirely, with floors and ceilings. And what we continue to hear is those floors and those ceilings keep moving up. So we've got floors in the mid 50s, ceilings in the 80s, pushing the 90s. And that's just going to keep moving up, moving up, moving up. So, yep, the market, these contracts are telling you, both the buyers and the sellers know, why would you put a ceiling at $85? Because the utility knows the price is going to go past that. They want some protection on that front. And the seller is willing to do that because they'll, at $85, the current producers are making money hand over fist. So it's a pretty wild market, and the supply side is just very, very fragile.
Yeah, I think that's really helpful to understand the mindset that we're looking at there. And one other follow-up question there. Is it possible that we could get to a point where we see contracts being done with companies that are in development, not yet in production?
Yeah, we've actually already seen that. So, some of the companies are holding out. Typically, those are the companies that will not be producing a lot of uranium. So, even if everything goes right, 2 or 3 years from now, they're producing 2 million pounds of uranium. That can very easily be sold into the spot market without disrupting the market, and they can get the spot price from that. So they haven't, and if they're well financed and the development is going smoothly, they don't necessarily need to de-risk for capital reasons or operational reasons by signing contracts for that future production. But Paladin signed some contracts for their brownfield restart of Linger Heinrich. Global Atomic signed a couple of contracts for future production. So yeah, it is already happening. And what we're hearing is that the companies that are, especially the brownfield companies that are restarting brownfield mines, whether or not they've been signing contracts, they're getting a lot of phone calls from utilities. So there's a lot of demand requests coming to them from utilities for their future production. And either they're choosing not to sign those contracts because they want to capture market pricing by the time they get into production, or then they won't necessarily be producing a lot of uranium and don't need to de-risk for capital reasons or operational reasons by signing those contracts. They've elected to not sign contracts. So the demand is definitely there for the developing companies. Yeah.
Right. So seller's market, as you've been emphasizing.
100%.
Right. And so for you, I think based on everything that you've been saying, you can tell there's much more room for uranium to run. So if you're an investor who's looking at this, hopefully you've already gotten it. Hopefully you're sorted out. But I did want to ask, are there things that people may want to do? Say you have your portfolio set up, things that you might want to do to hone it in different ways as the market progresses?
It's an interesting point in time right now because we've seen a decent run in the equities over the past couple of months. Most equities in the space are up 25, 35, 50%. Some have almost doubled off of the summer lows, which is pretty incredible. It's been a good move. Most of these stocks, technically speaking, at least looking at daily relative strength, are pretty overbought. So what we always recommend to people is to enter positions in tranches. and just don't go all in. Try not to chase when things are looking overbought. Don't FOMO into positions. But at the same time, you probably want to have a seat at the table, because I think this run right now has legs. I think we're probably maybe 6 or 8 weeks into a quote unquote wave 2 run of this market that could go way, way higher. And I think that it will, primarily based on the fact that uranium is going to go higher. And usually the equities, generally speaking, follow the price of uranium. When uranium moves up, the equities move up. Not necessarily every single day, and not necessarily even every single week, but on balance, for the bulk of the market, the equities follow the uranium price. And that is going to continue to move higher. How high? I don't know. If you look at just what is necessary for the market, for the supply side of the market to actually function properly and bring on new production, these companies are not in existence to do a favor to the industry. They want to make money. Okay, they're taking a lot of risk by operating wherever they're operating. And to build a mine is really, 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 really difficult. It's very expensive. It never goes as planned. And the companies are going to make money off of these projects. So what does that look like? I think that uranium price has to get minimum $85 to $100 to really, and stay there, to incentivize the projects on the margin. So we're talking about primarily that would be the large, low-grade mines in Namibia. There's a bunch of development-ready mines that have relatively low grades that need that pricing in order to be able to risk $300, $400, $500, $600, $700 million to build a mine and then operate at a profit. And so that's the price that the industry needs. And just like it overshoots to the downside in the bear market, it always overshoots to the upside. So, that wild card is the financial players, and how much capital and how quickly will flow into the SPUT Trust, into Zuri, into this new PFYN fund that's coming out of Singapore anytime soon. There's supposedly a decent amount of capital waiting for that fund. ANU Energy, that's in Kazakhstan, that's going to IPO in Q2 of next year, and they've already raised, I think, $74 million. They've got another $100 million and then a follow-on $400 million. And I think they've got a line of sight on that capital interest. We're already seeing evidence that there's demand for uranium in the market for an SMR build that's not supposed to be operating until the early 2030s. That's happening right now. So SMR demand, financial demand, that's just kind of gravy on top. That 85 to 100 is basically absolutely necessary for us to even have a remote ray of hope for the market to balance itself at some point in the next decade. I don't think it's going to happen. I mean, I don't think the market will balance itself. I really don't. But I hope that we get there that's coming from my nuclear advocate side. It's sitting on this shoulder. And then the investing side on this shoulder is like, this market's going to go nuts because there's not enough supply. And there's not going to be supply. You can't just snap your fingers and have a uranium mine pop out of nowhere. It's a lot of money, a lot of risk, a lot of time, a lot of headache. And even then, it usually doesn't ever come on time. So I think it's going to be a pretty wild next few years, to be completely honest with you. And I don't know where the price is going to go. It doesn't really make sense to me to inflation adjust the previous peak, because the previous peak didn't make sense either. The market then to balance needed $55, $60 a pound, and it went to 135. It doubled the incentive price. So could we go from 85 to 100 up to 200? Absolutely. Absolutely. Am I betting on that? No, I'm not. Not betting on the market going to where it needs to go for it to structurally operate. Anything beyond that is gravy on top.
Okay, and I have one last question. I don't think I've ever asked you this before, and I'm going to assume that this is in the far out future for you. But if we look at exit strategies, and what made me think of this is you're talking about a market that could potentially go into kind of a crazy mania phase. So how should people think about their exit strategy? How can they keep clear-sighted when possibly we're facing these gains that don't really make sense?
Sure. I honestly think that's one element that puts us at an advantage, and other institutional investors at an advantage, in that industry contacts are incredibly important. It's going to be really, really important to understand when some financial entities that are holding pounds are starting to sell. Not necessarily that selling pressure would significantly lower the price, because I don't think hedge funds outside of SPUT are holding a lot of uranium. But if you start to see hedge funds holding physical uranium sell, that'll probably be one point to be looking for. I honestly think, and this is something that I've been thinking about over the past couple of weeks since we've seen such an incredibly tight supply story right now, is that just trying to understand what sort of flex in the system could come in and could be sellers in the market. The only thing I can come up would be the Chinese. And I think that I already mentioned that, but I don't see them being sellers on balance unless and until there's a better supply story out there. So if they can, let's say, acquire a portion of NextGen's Arrow, or acquire all of Langer-Heinrich, they have a 20% or 25% offtake right now. That might be able to supply them with uranium that they could then take advantage of higher prices and sell into the market. But if they were to sell into, let's say, into a backwardated market, sell inventory right now, how would they be resupplying? There's just such a supply concern going out for the next 5 years that that doesn't make sense to me. And as of now, we have yet to see any evidence of anything like that happening. They've turned from sellers to buyers this year in the spot market. So there's no evidence of that yet. But if we start to see entities that are holding perhaps what could be seen at the time as an excess inventory, then that might be some kind of signal. But, again, that's not going to be something that's going to be out on Twitter. It's going to be based on connections with industry contacts that will be able to provide that information. So we maintain a wide web of industry contacts to make sure that we're kind of on the cutting edge of this information as it comes out. That's really important. Then, of course, there's just technical signals. You want to look for if the spot price if it starts to get chased after by financial entities, and we see a very high price spike, so the spot price goes way above the term price, that's going to be an unsustainable price spike. And you're probably going to want to take most, if not all, of your chips off the table at some point during that spike. And that, of course, is very difficult to do. But I honestly think at this point, the likelihood of a price spike is very high. And it's entirely possible that in the next year or two, we see a spike and it comes back down to incentive prices. And then we kind of continue on with that bull market. That's very likely to happen. That's what happened last time, honestly, before the Fukushima Daiichi accident, is with this crazy price spike that was driven by utilities were chasing it up to about $100 a pound. Then beyond that, it was financials. So it spiked up to $134. It fell all the way back down during the financial crisis. Hedge funds sold primarily, fell all the way back down to $40 a pound. Then it started to recover back up to that incentive price. It got all the way back up to $70, $75 before Fukushima. So we could have a similar situation where there's a squeeze on uranium, the price goes crazy, then that incentivizes some inventory to be sold in the market, the price comes back down, and then we level off at a higher low at a price that the industry needs to operate. That's entirely possible. I don't have a crystal ball, which is why we don't model out for financial demand, because it's unpredictable. But that is entirely possible. So exits, look for hedge funds selling, look for some evidence of liquidity coming into the spot market that was unexpected, and then follow, technical signals, just the charts of the equities, and treat all of the individual equities individually. You might not want to take a market signal and sell everything just because. And then, of course, classically, pay yourself on the way up. Don't try to time the top with a full portfolio, full positions in uranium equities. That'll be very stressful, very difficult to time the perfect top. In fact, nobody will probably be able to do it. So make sure you take some off the table on the way up.
Okay, I think those are all really good pieces of advice. Thanks for going through that. And I've kept you longer than I intended to, but it was really great hearing from you. So we can wrap up there unless you had any final advice, or if you wanted to leave people with where they can find you to learn more.
Sure. uraniuminsider.com is our website. I'm on Twitter relatively frequently, and I try to remain as accessible as I can to that. So if you have questions about the industry, about the market, or our service, you can hit me up there. Final thoughts really is, nothing could have predicted what's happening now besides a focus on the physical market. There's been a lot of concern about markets generally that's kind of kept the sector sort of risk off over the past year or so. But really, there's nothing that can predict this. It's not correlated to anything else, really. Sometimes it moves in conjunction with oil and gas, but sometimes it doesn't. It's a unique commodity. There's unique factors that affect it. So if you have money on the line, it's important to do the work, understand the fuel cycle, look deeply into the physical market. It's where we put the bulk of our focus because we want to understand supply and demand as much as we possibly can. And that's what affected our conviction over the past year and a half to hang on to positions or to add, during periods of very poor sentiment. We've had multiple. In the past year, we've had 3 periods where the sentiment was just very, very bad. And the RSI was falling off the screen to the downside. And, we were aggressively pounding the table at that time because nothing changed on the fundamentals. In fact, they only continued to improve. And you have to know the physical market. If you have money on the line in the sector, you have to. And that's really what we try to do, is take that complex web of information, distill it down into what matters for investors, and try to, during moments of poor sentiment, when we know what's happening in the physical market and we have a strong sense of what's about to happen, that we can communicate that to our members. So we're very excited right now. We're very hopeful. Sentiment's a little overheated. The charts are a little overbought, but I think this time it's a little bit, I don't want to say this time it's different because we've had this before, but we're in a different situation now than we were on the short-term rallies that we've had over the last year and a half. Those were always met with a lot of skepticism and on a full retracement. I don't think we're there. I think we're healthily in the next leg up in this market, and the uranium price should continue to move meaningfully higher, potentially into a spike scenario. So you want to have a seat at the table when that happens. Don't get too cute with trading in and out of positions. Just hang on. It's a volatile ride, but as you know, Charlotte, it can be a very, very rewarding sector to invest in for various reasons, but the volatility is one of them, and you can't have that upside volatility without the downside volatility. So we've had enough of that over the past year and a half. And yes, I think we're in a recession and going into a recession, and I think that we could have some choppy markets generally going forward for the foreseeable future until things change on that front. But at the same time, uranium's going higher. So take what that's worth. I don't know how much that is worth, but that's where we're at. We're very constructive on this market, and we're very long here.
Okay, I think that's a really good place to wrap it up for today. And I will say, from my much more limited perspective, it's starting to feel that this is different. So thank you so much for taking the time to come talk during this exciting time. Yeah, really great to have you.
My pleasure, anytime.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Justin Huhn with Uranium Insider. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.